Okay, so oil shock meets the Fed, and the economy right now feels like it finally sat down to relax. And then gas prices walked in like, hey, did you miss me?
Yeah, and last week was kind of a wild ride, so if you missed it, catch the episodes where we talk through the upcoming Fed meeting, oil prices, and inflation, because Kyla, this mess did not exactly come out of nowhere.
Welcome, everyone. This is Weekly Market Breakdown. Subscribe for more smart, funny breakdowns of the economy each week. Today, we're talking about how higher oil prices are colliding with the Fed's inflation problem, why markets suddenly got tense, and why regular people are once again being dragged into a global economic story they did not ask to join.
Which is the classic deal, right? Somewhere there is a major geopolitical shock, and somehow that ends with you paying more to drive to the store for cereal.
So here's the setup. The Fed kept interest rates unchanged, holding the policy range at about 3.5 to 3.75%. And the statement was basically, uncertainty is elevated, which is central bank language for we do not love this.
It is such a funny genre of communication. The entire global financial system hangs on these statements, and they always sound like somebody trying not to text too eager.
That is weirdly accurate. And under normal circumstances, a rate hold already gets people asking, okay, what does that mean? Is inflation still too high? Is growth too weak? Are policymakers just waiting because everything feels fragile?
Or Kyla, is it the secret fourth option where every chart on the screen is mildly concerning and nobody wants to be the person who makes it worse?
Honestly, yes, because inflation was already sticky enough to be annoying. Consumer inflation in February was 2.4% over the year. Core inflation was 2.5%, and wholesale inflation came in hotter at 3.4% over the year.
So inflation is still doing that thing where it says, no, I'm basically gone, while still standing in your kitchen eating snacks.
Exactly. It is lower than the ugly peak, but it is not back to being comfortably boring. And then oil prices jumped, which is where this gets extra uncomfortable. Crude moved above $100 a barrel several times this week, with reported spikes past 119 for Brent.
That is the kind of number that makes people suddenly start saying things like global energy corridor while pumping gas.
Yes, because the issue is not just that oil got more expensive. The issue is why that matters. A lot of global oil and liquefied natural gas moves through the Strait of Hormuz. So when there is fear about disruption there, markets immediately start thinking about supply, shipping, fuel, transport, and whether this is about to spread into a much bigger inflation headache.
Which is so rude. One narrow waterway can basically look at the whole world economy and say, everybody's budget is my business now.
Pretty much. And this is why the Fed gets stuck. Higher oil prices can push inflation up by raising transportation and production costs. But at the same time, they can hurt growth because households and businesses have less money left over for everything else.
Right? It is the world's least fun double feature. Stuff costs more, and also people are less able to afford stuff costing more.
Exactly. Oil shocks are nasty because they hit both sides. They keep inflation pressure alive while also acting like a tax on household budgets.
Which is why everyone hates them. It is like your paycheck got silently edited.
And that showed up fast in markets. Investors started pushing back expectations for rate cuts, stocks sold off, treasury yields moved around, and the basic message was, okay, maybe the path to lower rates is not as smooth as people wanted.
Wall Street had one of its classic little episodes where it spends months begging for clarity, gets some clarity, and then immediately panics about what the clarity means.
That really is the cycle. And one important thing here is that the Fed cannot directly fix an oil shock. People hear the Fed and think it controls inflation like a thermostat. But if the problem is geopolitical disruption to energy supply, monetary policy is kind of blunt.
Right? The Fed can make car loans more annoying. It cannot personally lower the price of crude by giving a speech in a serious tie.
Exactly. It can slow demand. It can affect borrowing conditions. It can try to keep inflation expectations from getting loose. But it cannot create oil, reopen shipping lanes, or make geopolitical risk disappear.
Which must be frustrating because central bankers absolutely carry themselves like people who would love to control the weather if given the chance.
That is fair. And the knock-on effects matter for regular people pretty quickly. Higher energy prices can mean pricier gasoline, costlier air travel, higher shipping costs, and more pressure on business margins. Then some of that works its way into prices more broadly.
Yeah, and consumers feel that immediately. Nobody waits for a macro report to know gas is up. They just stand there at the pump doing mental math and getting mad in real time.
And it hits when a lot of households are already stretched. Mortgage rates are still elevated, borrowing costs are still elevated, and basic living costs still feel high, even if inflation is cooler than it used to be.
That is why these stories land so hard. On paper, it is energy-driven inflation complicates the disinflation path. In real life, it is, cool, my commute costs more and I still cannot decide whether to refinance, move, or breathe.
Exactly. This is not just a market story. It is a cost of living story. If oil stays high, that pressure spreads into household budgets, small business costs, and sentiment.
Sentiment is such a funny word, too. Economists call it sentiment, but what they really mean is that everyday life feels a little more expensive and a lot less comfortable.
That is honestly a pretty good translation. And for small businesses, especially, it can be brutal. Higher transport costs, higher input costs, maybe weaker customer demand at the same time. That is a rough combination.
Yeah. Small businesses do not get to go, no worries, we'll just absorb this in our multinational cost structure. They're just out there getting hit by rent, labor, fuel, and vibes.
Jordan, fuel and vibes is maybe the cleanest summary of the real economy I have heard all week.
Thank you. I am available for several unnecessary consulting roles.
The real question now is duration. If this is a short-lived oil spike, then maybe the damage is limited. If it drags on, the Fed may stay cautious longer. Inflation may cool more slowly, and households may feel more strain than they already do.
So basically, the economy is once again in that annoying zone where nothing is fully broken, but nothing is comfortable either.
Exactly. Not disaster, not calm, just expensive uncertainty.
Which, to be fair, would also be a decent title for the whole year.
We'll keep watching the charts so you do not have to stare at your gas receipt and your bank balance at 2 a.m. wondering which one offended you more. Jordan, anything else you want to add?
I would say our economy at the moment feels about as stable as a shopping cart with one bad wheel. Thanks for listening. Subscribe, check out the other breakdowns, and follow for more.